Hey everyone, welcome back to Corporate Decoder, where we uncover the real story behind the numbers. Today we're diving into AST SpaceMobile's latest quarterly report. And let's just say they've been busy launching more than just satellites. If you like your financial analysis with a side of space drama, you're in the right place. And before we blast off, if you appreciate getting straight insights from these corporate filings, make sure you're subscribed and join our growing community on Discord. Linked below for even more in-depth discussions. Alright, so AST SpaceMobile, they're building this ambitious project to connect your everyday smartphone directly to a satellite network. No special equipment needed, just pure space-age connectivity. They file these things called 10Q reports every few months to tell us how they're doing financially. Today we're looking at the report for the quarter ending June 30, 2020-2025. So what's the big picture here? Well, it looks like they are definitely spending a ton of money on getting their satellite network built and ready to go. Their property and equipment alone jumped from about $337 million by the middle of this year. That's a massive increase, mostly driven by building out their satellite constellation. On the asset side of things, their cash position is looking pretty healthy. They have over $930 million in cash and cash equivalents as of June 30th compared to around $565 million at the end of last year. That's a significant jump, and it's good to see they're bringing in capital. Now let's talk about liabilities. A big number here is warrant liabilities, which jumped from about $41 million to almost $109 million. This usually means they've issued some warrants that are now considered liabilities because their value changed, and that's something to keep an eye on. On the equity side, things have also changed dramatically. Their additional paid-in capital shot up from about $969 million to over $1.5 billion. This likely reflects all the new shares they've issued to raise cash. Okay, now for the income statement. The picture here is pretty similar to what we've seen before. They're still losing money, and that's expected for a company building something this complex. For the 3 months ending June 30th, they reported a net loss attributable to common stockholders of about $99 million. That's up from about $72 million loss in the same period last year. And over the 6-month period, the loss was about $145 million compared to $92 million last year. It's a bigger loss, but given the massive investments in building out their satellites, it's not entirely surprising. A big factor in that increased loss is something called loss on remeasurement of warrant liabilities. Basically, the value of some of their warrants went up, and accounting rules say they have to report that as a loss. For the 3 months, it was about $65 million, and for the 6 months, it was almost $68 million. And for the 6 months, it was almost $68 million. This is a non-cash item, but it does impact the reported net loss significantly. On the expense side, their engineering services costs are up significantly. They went from about $21 million to almost $29 million for the 3-month period, and from $40 million to $56 million for the 6-month period. This is understandable as they're actively building and testing these satellites. Interestingly, their depreciation and amortization expense actually went down. It dropped from about $20 million to $12 million for the 3-month period, and from $40 million to $23 million for the 6-month period. This is likely because some of their older test equipment or satellites have been fully depreciated, and they haven't yet ramped up depreciation on the new commercial satellites. Looking at cash flow, the story is pretty straightforward. They used about $72 million in cash for operating activities in the first 6 months of the year. That's a bit more than the $64 million they used last year, indicating their operating expenses are growing. Where they really spent the money was in investing activities. They spent over $430 million on property and equipment in the first 6 months of the year compared to just about $62 million last year. That's a huge jump, and it's all about acquiring the assets needed for their satellite constellation. On the financing side, things are very active. They brought in over $875 million in financing in the first 6 months of the year compared to about $326 million last year. This is largely due to issuing new convertible notes and equity. It's also important to see how they're managing their stock-based compensation and employee incentives. Under their equity plans, they've issued a lot of stock options and restricted stock units. This is a common way to attract and retain talent, especially in tech and aerospace. As of June 30th, they still had a lot of unvested options and units outstanding, signifying ongoing compensation expense for the future. The company operates under an Up-C structure, which means they consolidate their subsidiary AST LLC, but there are other owners of AST LLC. This non-controlling interest was about 26.3%. This percentage has decreased from last year, which makes sense as the company issues more of its own stock for financing. Now, there's a really interesting multi-billion-dollar deal happening with Legato Networks, a company in bankruptcy. AST SpaceMobile is getting access to crucial mid-band spectrum, which is like the prime real estate for mobile communication. This deal is complex and involves significant payments and regulatory approvals. They've entered into definitive agreements and have even secured a credit facility to help fund it, though the deal is still subject to regulations and other conditions, so it's not a done deal yet. They raised a significant amount of money with new convertible notes. On January 27th, they issued $460 million of these notes. And in July of this year, they repurchased a large chunk of those notes and simultaneously issued more stock to the same note holders. This is a common financial maneuver to manage their debt and equity structure. Adding to that, they just issued another $575 million in convertible notes. In late July, they also put in place capped call transactions to manage potential dilution from these notes. It's clear they are actively managing their capital stack through debt and equity issuances. They've also been using at-the-market equity offering programs to sell their stock and raise capital. For example, under their 2025 agreement, they sold over 11 million shares in the second quarter alone, bringing in nearly $307 million. It seems they've utilized these programs to the max, terminating them recently. So looking at the cash situation again, after all these financings and expenses, they ended the 6-month period with a much stronger cash position of $937 million the previous year. That's a fantastic increase and gives them a lot more runway. However, they are still burning cash on operations and investing heavily in their future. The increased spending on property and equipment is directly tied to building out their satellite constellation. In the first 6 months of the year, they spent a massive $430 million on these assets. They believe their current cash and cash equivalents are enough for the next 12 months, but they are very upfront about the capital-intensive nature of their business and the need for future fundraising. They mention needing to launch over 60 more satellites and that each satellite can cost upwards of $21 million. So what's my take on all this? AST SpaceMobile is in a high-stakes game here. The progress on their satellite deployments, the partnerships they're forging, and the significant capital they're raising shows serious momentum. They are moving the pieces into place for their ambitious network. The sheer amount of money they are spending on property and equipment is eye-watering, but it's necessary to build a satellite constellation from scratch. The big risks, as always, are execution, regulatory approvals, and the ongoing need for capital. The Legato deal is a major opportunity, but it's not guaranteed and involves a lot of moving parts. They've successfully raised a lot of cash recently with new debt and equity offerings, which is a positive sign. Investor confidence seems to be there, but they need to show progress towards generating revenue to justify these massive investments. For now, they appear to be on track with their incredibly complex plan, but the devil is in the details. They're burning cash, but they have a clear strategy and significant backing. Keeping a close eye on their regulatory milestones and the successful deployment of their Block 2 satellites will be key. Alright, that's our breakdown of AST SpaceMobile's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.